everyone. Welcome to the Navigating the LIBOR Transition webinar by Refinitiv and the ACI, Financial Markets Association of Mauritius. I'm Peter. I work with Refinitiv, and I look after the community propositions across Sub-Sahara Africa. I'm sure we're going to enjoy the wonderful program that has been prepared for us. So let's move ahead and see what is in store for us. A few rules we can start off with, housekeeping rules. Please submit the questions via the question and answer box, and we will answer these at the end of the webinar. So feel free to submit them as the presentations go through. Use the toolbars at the bottom of the webinar screen to access resources such as speakers, biography, webinar materials, technical support, and a survey to capture your thoughts and views on the discussion. So what do we have lined up for us? Well, this is the agenda. After a welcome note from the ACI President, Rueda, we will move on to the presentation on navigating the LIBOR transition. This will be by Vincenzo. And then during this, we'll really enjoy looking at the challenges that the markets face, the reform and the timelines, and of course, what role Refinitiv plays in this. And then we will welcome Ashu to discuss and talk about the challenges that are faced by the Mauritian banking industry. And then we'll close off with some question and answers. Of course, those that you have entered in the Q&A box. A little bit about the speakers. So as you can see there, Rueda is the president of the ACI and Financial Markets Association in Mauritius. Vincenzo is the Global Director, Sales Strategy and Execution for our FX and post-trade products at Refinitiv. And Ashu is the head of cross-asset structuring team, global markets at ABSA. So we really appreciate the time and the effort they have made to ensure that we enjoy this presentation. So now we want to move on, and without any further ado, we'll welcome Rueda to proceed with her opening remarks. Thank you.
Thank you, Peter. Good evening to everyone. On behalf of the executive team of ACI FMA Mauritius and the Refinitiv team, I welcome you all to this webinar on navigating the LIBOR transition. First and foremost, I would like to seize this opportunity to thank the Refinitiv team for its valuable support to the region for organizing and facilitating this webinar today. This event has been organized in line with the association core objective, that is to collaborate with strategic partners like Refinitiv to bring to our members latest research and insights on the financial industry. LIBOR transition, as you know, has been defined as the movement of the financial markets away from using LIBOR to use risk-free benchmark rates, which marks one of the biggest challenges to the structure of the financial markets. For more than 40 years, LIBOR has been a key benchmark for setting the interest rates charged on adjustable rate loans and mortgages. As the loan markets developed, LIBOR was quoted for a wide range of currencies and tenors and found its way into a wide range of financial contracts, including derivatives and other commercial arrangements as a pricing source. However, this key measure has been burdened by scandals, and there were widespread allegations of LIBOR manipulation, resulting in a general loss of confidence among market participants. In 2017, the Financial Conduct Authority announced that it would no longer use its powers to compel market participants to make submissions for determining LIBOR after the end of 2021. So this transition definitely is going to entail significant legal, valuation, accounting, risk management, and system implications for banks and firms globally. Therefore, this needs an urgent call for the financial industry to accelerate the preparation for the transition away from the LIBOR by the end of this year. To better equip our financial industry with this predominant change, the association, in collaboration with Refinitiv, has brought to you today a panel of industry experts to discuss this landmark transition, its timeline, the market readiness, and challenges in the merchant banking industry. So without any further delay, I would now leave the floor to Peter, who will introduce our panelists for today's discussion, and we shall go into the agenda. Thank you.
Great. Thank you very much for that introduction, Rueda, and really sets the stage by showing the importance and the impact that the LIBOR rates have had and will have, and the replacements will have in the market. So now let's move on to the next speaker, and this is Vincenzo, who will now present his part on navigating the LIBOR transition. Over to you, Vincenzo.
Yeah, thanks, Peter. Good afternoon, everyone, and thanks to the ACI Mauritius and to all of you for having me here and for the opportunity to share an update, an overview on one of the most challenging projects the financial community has been dealing with in the last few months and years. The LIBOR transition is indeed progressing and approaching, I would say, its final stages and key first deadlines. So with less than 100 days to the end of the year, the questions would be, where do we stand with activities to be performed? How are the alternative reference rates being adopted across the jurisdictions, and what challenges still need to be solved? Now, if we look back one year, right, we definitely have more certainties, more rates, benchmarks, and several were the decisions and recommendations taken by the authorities and the relevant working groups and the community and the committees involved in this project. Obviously, the rhythm was set by the FCA on March the 5th, announcing the cessation date for the 35 LIBOR settings. By the end of the year, indeed, almost all of those rates will stop existing, with the only exception being the USD LIBOR, where the overnight, the 1, 3, 6, and 12 months tenors will still be available until the 30th of June, so the end of June 2023, with main objective for these being allowing the contracts linked to those tenors to run off smoothly. So no new, let's say, USD LIBOR contracts as of Jan when we wake up with the new year. And while 2021 was a rich year, as we said, in terms of decisions with an acceleration set in the path by the FCA and its announcements, definitely we cannot ignore the role USD LIBOR plays in the overall equation of this transition, given the ubiquitous nature of LIBOR, but also the amount of contracts exposed to USD, and the need to have more certainties on SOFR adoption and the term SOFR availability. Now, if we focus on the USD jurisdiction for a second, the SOFR initiative really helped in this project, right? It was announced in July and played exactly the role of a booster for SOFR adoption, introducing a prioritization, if you want, of interdealer trading in SOFR rather than LIBOR. Now, as you can see from the chart on the left, top left of this slide, definitely the SOFR First initiative played the role of a booster, right? So you can see the number of traded notional and trade counts in July peaked, right? So the effect is there. Obviously, this helped and helped a lot to increase the comparison and the relevance between SOFR-based and USD LIBOR-based instruments. And you can see in the bar chart in dark blue on the top right, it moved in July up to 6.2%. Nice increase, but definitely still low right? Especially compared to the main competitor, I would say. If you do the same comparison between SONIA and GBP LIBOR, which you can see here in the light blue bar chart, SONIA was already above 70% compared to GBP LIBOR. So definitely different speed in adoption across those two jurisdictions. And you will see this element of different speed is very common in this LIBOR transition. In any case, I would say that the SOFR First initiative really boosted SOFR adoption and liquidity in the market, liquidity on SOFR, which was one of the most important objectives, because that increased liquidity on SOFR can definitely and has helped the ARC, the Alternative Reference Rate Committee, based on that liquidity to finally recommend for a term SOFR, which was selected in terms of a producer. It is already produced by the Chicago Mercantile Exchange, CME, and obviously those rates are already available via the Refinitiv platform. Now, interestingly, I would say there is another element that I would like to share with the audience, because the time taken by the ARC to qualify the term SOFR opened the door, right, to a certain extent, to another discussion on the so-called credit-sensitive rates. You may remember in April, May, the ARC announced that probably there could be a delay, or they cannot guarantee that the term SOFR would have been available by the end of the year. So this generated a little more of thoughts and opened the door to the concept of the so-called credit-sensitive rates. And so the ones incorporating a credit component, the one provided by Bloomberg, BSB, IHS, DMRIBOR, and a few others, which obviously triggered different reactions from the market, from the authorities and the working group. Some of the criticism expressed in the market relates to the fact that those credit-sensitive rates may replicate to a certain extent the construct of LIBOR, and so bringing back some of the so-called old problems. Now, whatever you may decide to think or have as an opinion on this, definitely IOSCO, the International Organization of Securities Commissions, recently enhanced a little bit and raised up the bar of scrutiny on those rates producers using the IOSCO compliance hallmark authorization. And even more, the news reported an interesting comment by the SEC chairman, Gary Gensler, mentioning, it's worried that those rates can be aligned with IOSCO principles. In any case, let's see how the market reacts if those rates would be adopted or not. For sure, they are not recommended, but we stay open from a Refinitiv perspective. We're just a receiver, and those rates we make available in line with the spirit of being open and providing the tools to the market, whatever is needed. Similar to the SOFR First initiative, there is another interesting one that kicked in the 21st of September, so last Monday actually, or last Tuesday, I would say, is the RFR First initiative, with the FCA and the Bank of England encouraging market participants in a switch from LIBOR into risk-free rates in the cross-currency swaps market. And that actually took place. We can see more liquidity, and it's contributing, right, to push the industry to make the move and really adopt and embed the risk-free rates in their flows, which is actually what needs to be done. Remember, it's always a match to be played together. On one side, there are authorities providing instructions and guidelines. On the other hand, there is the private sector with banks on one side, financial institution not issuing any more instruments linked to LIBOR, and on the other hand, let's say a corporate not asking for instrument based on LIBOR. So it's a game that needs to be solved. It's an equation to be solved with those three variables altogether. And now if we zoom for a second out and we look at this project, the LIBOR transition, one thing remains extremely clear, and I think was clear to everyone since the very beginning of the project. With LIBOR transition going in, we enter a new world. We move from one administrator producing 35 LIBOR settings into a multi-rate environment with multiple administrators, multiple rates, similar in concept, but having and embedding some differences. Some of the risk-free rates are secured, others are unsecured. And so this multi-rate environment with more jurisdictions, more authorities and working groups involved and different level of liquidities triggers a different speed in the adoption, which we mentioned before. Now, if we focus for a second on the adoption of risk-free rates in swaps trading, and just to give you a bird overview on what is happening based on August data and focusing on swaps trading, you can see starting from the chart on the left and looking at the bar chart, the yellow-red one below, you can see that for SONIA, there is an interesting, at the top left of the chart, in GBP, we can see the SONIA yellow bar already at 75% in August compared to all swaps trading. Japan and Switzerland grew nicely during this summer, especially in August and then also in September, but already above 40% and reaching 50%. Obviously, the picture changes nicely, depends from the point of view. When we look at the US, where still the percentage is low, is in the range of 10-15, and even less for Europe with Euro short-term rate, whose liquidity definitely is still to be seen, is still to be touched. There is expectation this can grow in October, November. There could be a Euro Ester or Ester First initiative as well kicking in. But definitely you will get the concept of the lacking of liquidity on Ester itself, right, may impact decisions on having a term Ester, which was actually the point taken by the ARC committee in the US before selecting CME for the 10 SOFR. If we look at Euro with a little bit more of attention, if we zoom on Europe, I think it's important to remind that while there is limited usage of Euro LIBOR and exposure to Euro LIBOR rate in Europe and across the globe, Euro LIBOR is still there, right? So it's surviving, let's use this expression, still there. It's a robust benchmark for the market. And its strength and its robustness was proved thanks to the new hybrid methodology that was introduced almost 2 years ago, which is based on transactions versus quotations, so different mechanism compared to the old LIBOR panel banks approach. And there is a waterfall methodology that is very common now, but was definitely important to guarantee the success and the robustness of Euro LIBOR. Different story for EONIA, the Europe Overnight Index Average, which will be actually discontinued. The discontinuation date is set for the 3rd of January 2022, and obviously there is a transition to be defined to move from EONIA to Ester. And actually, as you know, EONIA was already, as we say, esterified, meaning that it is already calculated today as the sum of Ester plus a spread. So it was an announced move, if you want. So the encouragement and the invitation is for EONIA users to move, basically, and to stop issuing new contracts, especially if the maturity goes above the cessation date. Now, you would agree with me that overall, when you approach whatever final stages of whatever project, when you reach the end with less than 190 days to go, the real problems need to be managed in whatever field, in all industries, I would say. And this is the same for LIBOR. LIBOR transition makes no exclusion, no difference. The issue we are referring to is the one of the so-called legacy, tough legacy contracts, which is becoming more and more relevant as we approach the end of the year. And by the way, by tough legacy, we refer to those contracts which are very complex to update, to move and change and adopt a new alternative rate in time for the cessation dates of the relevant LIBOR tenors. Think about a consent solicitation process that takes longer or ages and it doesn't match with the cessation date of the LIBOR rate which is used. For that reason, the FCA started actually a consultation which is closed on the 27th of August, exactly with the ambition of defining the path for the so-called synthetic LIBOR. Now, what is the synthetic LIBOR, and most importantly, what is not, right? First of all, the synthetic LIBOR will be relevant for GBP, for sterling and yen. It will be available for 3 tenors, 1, 3, and 6 months, based on the current communication issued by the FCA, and will be available only for a limited amount of time and only for tough legacy products, not for new contracts, which translates into this is not a delay of the program. It's a temporary solution for the tough legacy ones. The rate will not be calculated the same way as the LIBOR, but will be, as you can imagine, to replicate something that is economically equivalent to the current rates, will be the sum of a forward-looking rate, let's say SONIA, plus a fixed spread to create something that is economically similar, right, to the previous one. But the most important thing is that it will have a deadline itself. So it's just an extra amount of time to manage those tough legacy products. The concept is for tough legacy contracts, even if there is a synthetic LIBOR, still the migration needs to be completed. Now, what is the next step here? Obviously, we're waiting for the FCA to come up with, communication, formal communication expected in Q4, anticipated by them to come in Q4, and we will get, the formal statement on this initiative, but also the list of the instruments which will qualify for this approach. Right, so we can expect the list not to be big, as you can imagine, but definitely it will be a very niche activity to solve a problem exactly for the tough legacy only contract. So let's stay tuned and let's see what happens. While this is the one of the last moment issues to be solved, obviously this does not hide from ourselves from the wider context, right? The wider context is clear. We knew, again, since the very beginning, the LIBOR transition comes with challenges. USD LIBOR is ubiquitous, is everywhere, right? So again, if you accept the analogy, one can say it's just like moving from kilometers to miles or vice versa. True, is a different rate, but it's not just a conversion. It is about updating all the cars, all the cockpit of your car, the driving instructions, all the signs along roads, small roads and big highways. So the project is big. And so comes with challenges. And these challenges require action. And so the message is, if not already completed, to accelerate, right? Because there are some financial, risk components to be managed, typical basis or valuation risk, because there is a different number, there is a different rate. And then there is an interesting section of the so-called non-financial risks to be managed, right? Think about, obviously, the burden of contractually repapering and adjusting all the contracts. the operational component and the technological one not to be neglected. Your systems, our systems, the community systems and IT services needs to be updated to ingest a new rate and to replace the previous one with new ones. And that can be a very interesting exercise to be done together with risk management services provider, treasury management systems. And obviously there are impacts as well on legal, on the governance, on how you communicate with your counterparties and customers, the change of those rates in the contracts. And even from a corporate point of view, thinking about our colleagues in the corporate treasury world, the impact on transfer pricing and intercompany funding, there is an interesting set of risks that needs to be managed. It's not impossible, but everything needs to be done in time, and no one wants to reach the 29th of December, right, to be ready on this, but everybody wants to enjoy, as we said before, a smooth transition where all the parties are working together. Now, in this nicely complex scenario, because obviously the LIBOR transition is one of those projects that happen once every 40 years, right? Refinitiv is committed to providing the data customers need to adjust their operating models across the full workflow of activities, which translates into data to be seen and watched with human eyes, data and feeds to be consumed by machines, analytics to observe, tools to price, curves to evaluate, but also to create new financial products, new benchmarks that can help in this, I would say, smooth transition, possibly smooth transition. Now, if I look back at my experience of the last 5-6 months at least, or I would say after the announcement of the 5th of March, these are some of the key words, right? The cloud of the keywords I've been working with and listening in terms of feedback questions from the market, right? And you would recognize the fallback language, the ISDA protocol, the concept of tough legacy we just touched. But if we focus on the top side, on the blue section, right? There were a lot of questions on term rates, on swap rates, fallback, and again on the ISDA protocol and how to access the ISDA fallback rates. Now, just to give you a quick recap, is going through those market topics via the lens of Refinitiv key initiatives. What we have been working on, well, different things, and definitely you can rely on us as a trusted partner. But definitely, if we look at Term SONIA and so term rates, we are producing Term SONIA. We started; it's already in production since several months. It's in production since January, I think, 2021. And it's a big achievement because it's been really, really well received, very well received by the market, by our customers, and adopted by almost all of the, in almost all jurisdictions, irrespective of this being a GBP instrument, so a term SONIA. But a term rate is key for some specific component of the markets. I'm thinking about cash, I'm thinking about loans. The other key investment, and by the way, the term SONIA is managed under all the rules of the benchmarks, and so you can stay safe, and all the documentation is available together with the methodology in our website. Another big thing, while focusing on the risk-free rate, the overnight, and some of the term rates, going up to 1 year, was to think also about the other part of the curve. So the swap rates. And specifically, as of today, we already produce the Tokyo swap rates, which obviously incorporate a component of JPY LIBOR. And so with the end of life for JPY LIBOR coming end of the year, there was a need to refresh, update to some extent that Tokyo swap rate. And so we have started producing, is currently in prototype, a Tokyo swap rate for the swaps referencing TONA, but also a JPY LIBOR Tokyo swap rate fallback version for the instruments that need to use the fallback and that already incorporate and then mature after the deadline. So another big investment we have done from the benchmark team. And then the other big element, again, considering the relevance of the USD LIBOR, again, in the total equation of the migration from LIBOR, is the USD iBoard cash fallback. So the fallbacks for the cash market in dollars, right, in US dollars. And the ARC made, so the Alternative Reference Rate Committee in the US made an important announcement and decision, which was to select and recommend Refinitiv. Refinitiv will be the sole and is the sole benchmark administrator for the USD iBoard cash fallback rates. The rates are available for you in our icon, in our services, and everything that we are providing today, we provide both, as I mentioned, for human eyes and for machine consumption. And again, all of the details on USD iBoard cash fallbacks can be found online. And actually in the resources section of this webinar, you can access some key information through the resources widget. And finally, the other big question I got, especially at the beginning of the year, was, can we access ISDA fallback rates? And the answer is yes. The ISDA, for what is related to ISDA fallback rates, Refinitiv is authorized distributor. So if you adhere to the protocol or if you want to access the ISDA fallback rates, yes, you can via the Refinitiv platform and services. Now, coming to a conclusion, more or less, I would say there are several things, many things we have done and strategic key initiatives that we have introduced and started working with when we started the LIBOR project a couple of years ago, more or less. What we can serve the market with, what you can use is a wide set of tools and data. It's a mix of content and analytics. The market data, so all the risk-free rates, the new average rates produced by the different administrators and central authorities, the brokers' data, which are really providing, the pricing for some instrument. This morning I was checking some of the first basis swaps, Ionia Ester, which some brokers are starting to produce. The reference data, the fallback language details is important. It's important to check if a specific instrument has migrated, right? Is already embedding a fallback language or has identified an index, a rate to transition into. And if we stay on the blue side, benchmarks, we commented the term SONIA, the Tokyo swap rate for the swaps referencing TONA, and we are open as well to produce a term Ester. We have been presenting to the working group, and we await information on how to move on, but we are ready. Also leveraging the good job done with term SONIA and other benchmarks. Fallback rates, we mentioned the USD IBOR. ISDA fallback rates for derivatives are available via our platform. And then we made a huge improvement in terms of what is available via search. So being able to identify if an instrument has transitioned to another rate, if and how many new instruments have been issued in the last 6 months, and having an underlying rate equal to SOFR, SONIA, SARON, whatever is needed. And most importantly, to answer also one point, the new zero coupon curves, right? Because if you start to see and use and have an instrument based on risk-free rates, then you need to evaluate, and then you need a zero curve that is based on risk-free rate, and that is currently available, including the facility to price a swap using SONIA, using all the rates that are now available, the so-called alternative reference rate. Before closing, I wanted to mention that in this complex environment of several administrators and several rates, what we have done for our customers was to take a step into the simplification, right? And so we have launched an app, which is called iBoard. So just type iBoard, and it's an overview which, as you can see from this slide, makes a recap of all the jurisdictions, all the incumbent rates, and all the alternative reference. And for each of the top 5-6 jurisdictions, you just click on the tab and you can expand and know everything about US dollar and the different other several jurisdictions, with a drill down into the different rates available, the different broker content, and the ISDA fallback rates. So everything available in one place for you to start and let's say contribute to your activities. And with that in mind, I would like to thank you for this 20-25 minutes navigation into some of the key concepts of the LIBOR transition and the wider iBoard reform. And with that in mind, I would like to pass the microphone back to Peter. Back to you.
Thank you very much for that. Really, really appreciate that, Vincenzo. And of course, explaining all the various options that are available, and of course the timelines. I see there's a lot of questions that have come in around that, so we'll definitely tackle those in our Q&A, and I'm sure Vincenzo will be glad and happy to respond to those. So now we want to move on to our next speaker, and this is Mr. Ashu, and he will take the LIBOR discussion a little bit more local to the Mauritian market and discuss some of the challenges that are faced by the Mauritian banking industry with regards to this transition. So over to you, Mr. Ashu. Thank you.
Thanks, Peter, and thanks, Roeda, for giving me this opportunity to present on the LIBOR transition and the challenges faced by the Mauritian banks. So, I mean, as you know, LIBOR has been the cornerstone of global finance for over 50 years. There are about $400 trillion of contract tied to LIBOR. It is often referred as the most important number in the world. So when you transition from LIBOR, of course, there will be challenges and there will be many issues. So I think Vincenzo covered a lot of the slow market adoption. Same in Mauritius. I think we've seen a two-speed transition. I think the challenges remain more on the loan products in credit. I would say loan products in general. I think on the derivatives side, the transition has been faster. And also we've seen a two-speed transition between SONIA and SOFR. So I think this, as Vincenzo mentioned, the SOFR initiative have really helped liquidity in SOFR and the publication of the term SOFR. I think the biggest challenge remain also in the documentation and also on the contracts that have to be reviewed. I mean, clients have faced a lot of challenges, again, on loan products, but I will go in further detail for that. In general, I mean, clients have faced issues in reviewing their docs. Yeah, but another probably non-financial risk that we've seen that is a big challenge is a conduct risk. I would like to focus on that because we want to make sure the contracts pricing have been fair and the choice of replacement rate have been fair as well. We want to avoid any mis-selling or market disruption, and we also want to avoid any conflict of interest inside the bank. I think there's been clarity on the forward-looking rates. CME is publishing the term SOFR, but I will go through two examples. I mean, despite the new term SOFR rates, I will go to two loans example. We will see that, clients or haven't really used this term SOFR. I think the other challenges remain more, again, on the operational readiness, on system and processes. Again, compounding interest rate in arrears on a daily basis is more complicated than when you have a more forward-looking rates. But that has been resolved. And finally, one of the biggest challenges the banks are the balance sheet impact, especially banks that are funding themselves in the wholesale market, in the unsecured market. It can cause a lot of issues. I mean, we've seen that in the US, and this is where I will speak a bit about the credit sensitive rates. So in general, Mauritius, as you all know, it's a vibrant offshore banking sector. It has an open capital account, so there's a lot of flow of foreign currency in and out of the jurisdiction. Dollar, GBP, and euro are probably the most dominant currencies. So banks are facing challenges on both sides of the balance sheet, on the liability side, but also on the asset side. But I think in terms of derivatives products, I think banks have made a lot of progress in terms of signing the ISDA 2022 fallback protocols. I think many banks have adhered to the protocols, and some of the banks are still looking at these protocols. But the derivatives market, to be honest, in Mauritius is not that big. I think we are seeing more issues on the loan side. That's where I will probably spend a bit more time. So let me go on the SOFR derivatives, more markets product. It still is a catch-22 liquidity situation. I think that has significantly improved since July. The CFTC push for the RFR First initiative, and in the UK, the FCA is pushing for the RFR risk-free rate first initiative. But the volume of interest rate derivatives contract still remain very linked to SOFR are still quite low. I think if I look at the ISDA numbers just for August, they only represent about SOFR contract only represent about 12.5% of the total interest rate derivatives market measured in DV01, which is the sensitivity to rates. However, in the short dated contracts, there's been a lot of progress. 38% of total short-term rate futures are linked to SOFR. So in order to accelerate the transition in the cash product, you need more liquidity and more trading on the SOFR derivative side. And another enabler to improve liquidity is the debt capital market. So we've seen a lot of issuance of bonds from corporates. It started with the GSE in the US, Fannie and Freddie, and also the official institutions such as the iBoard, the IFC, has been issuing SOFR-linked securities. And obviously, when they sell these bonds, immediately they will do a liability swap to swap it to their funding rate. So I think one of the biggest development we've seen is on the corporate side. We've seen a lot of issuance from the regular borrower in the capital markets, issuing floating rate bonds linked to SOFR. So I think the progress here, it's moving faster than the next section, which is loans. Interesting enough, LIBOR was born on the back of syndicated loan in the late 60s. It was on the back of a loan disbursed to the Shah of Iran and underwritten by JP Morgan at that time. So if you want today, the biggest challenge remain on loan products. Because in general, the loan market prefers to see a forward-looking rate, and they also prefer a credit-sensitive rate because that match their liability side on the balance sheet. I think the fallback language in loan agreements have been I mean, they are on the process of being finalized by the loan organizations, such as the LMA and LSTA. But the market is adopting the hardwire approach, and the ARC is pushing for the ISDA fallback spread. Remember, the ISDA fallback spread are backward-looking because we're looking at the median between LIBOR and the SOFR over a 5-year period with a 5-day look-back window. So that obviously creates challenges. I mean, there's a very interesting case study. This was the first leverage loan that was financing a buyout by Cargill. It's the first leverage loan tied to LIBOR, and guess what? It was, sorry, to SOFR, and guess what? It was priced with the 3 months LIBOR still, but the pricing will switch to the 3 months SOFR on December 31st, and all the fallback rates will apply on the 31st of December. So this is one example. The next example, I would like to go through that. This was Ford issued a big syndicated loan, and again, they did not adopt the term SOFR. They used the daily simple SOFR, and the pricing had three components: the daily simple, again, daily rates, SOFR rate plus the 200 basis point margin, and roughly an 11.5 basis point adjustment, which is the difference between LIBOR and SOFR. If you look at the fallback rates issued by ISDA, they are about 0.26%, and the gap between LIBOR and SOFR, which is more reflected by the basis spread swap market, is about 0.11 basis point. I think this is also due to the persistent low rates environment we are currently facing. So there's clearly a difference between the backward-looking ISDA, which is very rule-based fallback rates, and the basis spread, the basis swap spread, which is a more forward-looking, which is reflected by the market. So we go to I think Vincenzo mentioned that, the alternative credit sensitive benchmark. Yes, they've been on and off. I mean, I think they clearly created a lot of pressure on ARC to push for the term SOFR. But I think the way I see the market, we will see both rates in a post-LIBOR environment. So most of the contracts will be priced on SOFR, we know that. But there's clearly a preference, especially by smaller banks and banks that fund themselves in an unsecured market, to look at the credit sensitive rate. And they're priced, they're based on actual transaction. It's a smaller pool of transaction. Again, the difference, they're not priced out of expert judgment or contribution from a panel of bank, but they're usually priced from commercial paper, commercial CDs, bank deposit, and short-term bond yield. So we have quite a number of these rates around. One where we've seen more trades and transaction has been the BSBI. Even Bank of America issued a $1 billion FRN linked to the BSBI, and there was a basis swap SOFR BSBI in the market between two US banks. So I think the smaller regional banks in the US, I do believe they will continue to push for these rates. In Mauritius, I'm not too sure. I think we will price most of the loan probably on SOFR, because this is what most of the, this is where hopefully most of the loans will be priced in. Again, sorry, this is Bloomberg, but we can see the difference, the correlation between the two credit-sensitive, forward-looking rates. That rate is very highly correlated, and they reflect the true funding of commercial banks, especially in period of stress. Because when you have a shock in the market, your cost of funding is very far from the secured funding market linked to SOFR. Yeah, so I think the other big part of the transition in Mauritius is the client engagement. I think we have different types of clients. Sophisticated clients understand SOFR, they understand coupons in arrears, that is fine. But I think for smaller clients, it takes more time. I think we've been engaging with clients since 2018. Institutional clients are probably more important. They do understand the two rates, and we also have clients that have traded, interest rate swap or risk management products, and all these products needs to be renegotiated and repriced. Again, the next section is on this project in general. It's a big multi-dimensional project across banks in the country. It has been approved, the transition at the board level, and most banks are implementing it via a steering committee with all the internal stakeholders, but also the external stakeholder. So again, I think it's been one of the most complicated projects that the local banks have faced since the last couple of years. But in general, I think the banks have been on track and has been on their transition. I do chair the MBA LIBOR transition committee, and we've had very lively discussion over the last, I would say, 4 or 5 months. And I'm very pleased to say that in general, we've been on track on the transition. Some banks are probably more ahead in the transition, but we are all worried about the tight deadline that is coming on December 31st. So I think that's the end of my section. Thank you, Peter. Thank you, Ruwaida and Peter.
Thank you very much, Ashu, for your presentation. So this brings us up to the Q&A section, and we do have quite a few questions that have come in. So we'll move on straight into answering these questions. So the first question we want to ask, and this we can direct to Vincenzo, when will the forward SOFR rates be available?
Yeah, thanks. I think if by forward rates we mean the term rates, so the term rates like the term SOFR, I would say that the term SONIA, term SOFR, the TORF for Tokyo is available. There is no term Ester so far in Europe by decision, meaning that there is not yet any indication of plan to construct, calculate, or assign the construction to anyone. And there is no term rate for Switzerland. So the SARON will not have a term rate by decision. So the decision was taken by the working group not to have a term rate. But again, in the iBoard app, there is a nice recap of all the term rates, and definitely those are the key ones for the top jurisdiction. So they are available. Majority is already available, including the term SOFR, which was mentioned before, right? So we took a little bit of time and then an acceleration in order to be created.
Okay, great, excellent. Then we have another question here. Would you say that plain vanilla FX swaps and forwards are impacted by LIBOR transition? Perhaps we can push that to Ashu.
Thanks, Peter. So I'm not too sure. Are we talking about vanilla FX swaps here. See, if they are FX swaps, they're not really impacted by the transition because we price them out of fixed rates on dollar or euro. If we're talking about cross-currency swap, this is a different story. Yeah.
Okay.
In cross-currency swap, yes, of course, they will be impacted by the transition.
Great, excellent. Thank you. And then, of course, whoever asked the question, if you want to get any clarification, please feel free to clarify a little bit more. Then the other question that we have is, are term SONIA rates computed through compounding in arrears? So this really is a question around the methodology used to calculate the term SONIA. And I'm sure we'll be able to share that in our resources. Vince, I think that's something that we definitely can do, correct?
Correct. It should be there, and even by the web page, the full details of the methodology for the calculation of the term SONIA is available and public.
Okay, great. Then the next question we have here, is Refinitiv the sole institution that publishing the SONIA term rate? Perhaps Vince?
Yeah, it's a good one. The term SONIA rates are produced by Refinitiv and by IBA. So there is this approach taken for SONIA, which is not similar to the US one. So there is no selection of a provider, but it's a market-led selection. So in the field, there is actually ourselves and IBA, which is ICE Benchmark Administrator.
Okay, great. Then the next question here is asking for a little bit more explanation. So again, I think, Vince, you'll be able to touch on this. Please expound a bit more on iBoard cash fallback rates.
Yes, sure. And thanks for the question. It's a good one, and there is never enough time to cover everything in detail. To recap some three basic concepts about that. Selection took place the 21st of March with an announcement from the ARC to select Refinitiv to publish ARC recommended spread adjustments and spread adjusted rates for cash products. So this is a rate which is of interest for all financial market participants exposed to legacy cash products referencing USD LIBOR that will expire after June the 30th, 2023. And those contracts may not have suitable fallback language that is able to cope with the permanent cessation of the USD LIBOR. Our rate is available in two main approaches. There is the Refinitiv USD IBOR consumer cash fallbacks and the Refinitiv USD IBOR institutional cash fallbacks, which respond to two different needs from the market, consumer market and institutional one. Again, all the details, the methodology and the different tenures, you can check on the iBoard app on Icon, but also in the resources in the web page, there is full detail about the methodology and for the how this is calculated and how it is distributed.
Okay, great. And then another question here. What is the feedback on the uptake of the term SONIA rate in the market, and any insight on the depth of liquidity? I can open this up to both Vince and Ashu.
My quick comment would be that on term SOFR, you said term SOFR, right? The American one?
Yes.
Yeah. The quick comment I can make here, let's see then how the market will respond to that, is that the move out of USD LIBOR is to go into SOFR, right? And this is the main move. Then there are specific instructions given from the ARC when it comes to the cases, the use cases where a term SOFR can be used, right? And we are talking here and thinking about the recommendation by the ARC is loans, activities, cash market, right? And definitely there is a no for using term SOFR into the derivatives market coming from the ARC. Let's see how this is evolving and how the usage of term SOFR will develop after its creation. Let's not forget, it just came in late July, basically.
Great. And then we have another question here. Why is there always a gap between SOFR and LIBOR? And is it dependent on the tenor? Maybe Ashu, might you have a comment on that?
So there is the gap between LIBOR and SOFR, right? So obviously one is credit sensitive, and the other one is, what is the SOFR? It's backed by overnight reverse repo that are cleared by DTC in the US. So obviously the one has a credit sensitivity because it's interbank, and the other one is risk-free.
Great. So obviously the calculation and the source of the data definitely does affect that. I'm conscious of time, and I think we have reached our time slot, 1 hour. We do have many more questions, and what we will do is we will answer these questions directly over your email addresses that you use to register. So we'll ensure that everybody who asked a question does get a respond on this. So thank you very much for those questions, and we will definitely get back to you on that. Just as a way of closing, we want to also quickly mention, especially to the attendees from Mauritius in the Mauritian market, we will have a few more sessions set up, but these will be focusing more on the matching rollout that is currently ongoing in Mauritius. So we really encourage you to look out for those and to ensure that you attend. And then many of you, I think, have already received the documents that are needed to enroll onto and upgrade your systems onto the matching platform. So please take a look at those and send them back accordingly. So without any more, want to thank all of the speakers. Want to really thank Wrapup and the ACI for helping and getting together this webinar. We also want to appreciate Vincenzo for the detailed presentation and the timelines and really how it affects and the markets. And of course, Ashu, thank you very much for giving us that in-depth analysis on how it affects the Mauritian market. So thank you all of you for attending, for your questions. We will get back to you. And remember, the resources will be shared in about a week, next week, early next week, directly to your email address, along with the recording of this webinar. Thanks again for your participation and attendance. Bye-bye.
Thank you.